A private annuity. That's the topic of this Invest Minute in today's general finance lesson. How they work, are they useful, and why some may have a different opinion. I'm Jonah. I'm one of the banking bros here at the Cash Compound, and I'm cracking the code today on this saving and investment vehicle, the private annuity. Using a private annuity to exchange a sizable income-producing asset for a lifetime income lets a property owner enjoy important tax benefits. And if properly structured, the asset is excluded from the owner's estate. So here's how it works. Proper business valuation is essential, and there are risks. The buyer risks the annuitant living beyond expectancy, which would increase the purchase price. Because annuity payments are unsecured, the annuitant risks the buyer becoming unable to make ongoing payments. Each payment the owner receives is part tax-free return of basis in the property, part capital gain, and part interest. Now here's why it's useful. The tax benefits make private annuities attractive, offering a way to transfer assets to family members without gift or estate taxes. For property with a low basis, the owner can recognize capital gains over a period of many years while enjoying the security of lifetime payments. Here's why some don't like this plan. The value of the transferred assets, along with the Internal Revenue Service life expectancy table and IRS Section 7520 interest rates, are usually used to calculate the amount of these annuity payments. Once the rate and the payment levels are set, they usually cannot be changed. If the annuitant or the annuitant's beneficiary dies early, the obliger may receive a windfall. This type of annuity will often be held in a trust, often known as a private annuity trust. Generally, trusts can be structured as their own business entity for operational and tax purposes, and there are some limitations for grantor trusts. The IRS 2006 changes required that the sale of the asset must be charged with a capital gain at the time of the exchange. This generally eliminates a non-taxable sale. It also makes the use of private annuity trusts more common for bequeathing assets to beneficiaries. Here are my thoughts. My recommendation is to use a trusted professional when exploring this option because, again, proper business valuation is essential and there are risks. Now, I wholeheartedly agree and support passing income-producing assets to the next generation. We actually teach that on our channel through the use of the infinite banking concept. If you haven't heard of that before, it's utilizing the guaranteed growth in cash flows from life insurance without any risk of market forces. Because these private banks are built inside of life insurance policies, that means that one day I will too be passing a substantial benefit to the next generation. The difference will be that life insurance proceeds are not considered ordinary income and therefore will have no concern of capital gains, gift, or estate taxes. However, throughout our lifetime, we actually are able to use the guaranteed cash flows through these personal infinite banking policies to fund the purchase of other income-producing assets. Those assets, of course, must be passed on after our graduation from this world, and for this reason, a private annuity can be a great option to explore. You can personally click the link in the description to see my video on how you too can have guaranteed cash flows that you may use to purchase income-producing assets. Are you ready for it in under 60 seconds? Here's your Invest Minute. 2 or more individuals enter into a contract transferring an asset, for example, a family business or real estate, to children or to other beneficiaries, in exchange for a lifetime annuity payments of equal value, usually paid out of income generated by the business or the other asset. You can subscribe to this channel and join us for our next Invest Minute as we do a quick breakdown of credit shelter trusts.